I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone exciting, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward at what might happen in the next week. And we hope lots of great ideas or opportunities for you throughout the show. Well, this is certainly an interesting week. Not a lot going on. Well, up until Thursday, the market looked okay, actually, trading really in that range that it's been in for, well, these 2 months or so. But then things seem to have changed. In fact, it's like somebody just flipped a switch, and I'm telling you, the sentiment is changing quickly, and it's all about the interest rate picture. Well, the stock market, which hadn't changed very much, now has got its biggest down day on Friday in a couple of months, down just about 2% on the day for most of the indexes as I'm starting this show, and that's down about maybe 1.5% for the week or so, a little bit more. It's all about the bond markets, because that all changed also on Thursday as bond markets around the world have plunged. Thursday and Friday have just been days when they have been decimated. And it's, what happened really was the central banks. And how many times have we talked about central banks on this show and how they are really the problem? And what happened was that they have just gone too far, and they've gone to the place where they almost don't have anything that they can do anymore. The ECB, they came out and they announced no change at all. They said they're holding interest rates where they were, and that they're going to continue buying about $90 billion worth of bonds every month. The problem is that they had to go to corporate bonds, and who knows what else they're going to start to buy, because they are buying up all the supply of these bonds, trying to put liquidity in the markets. That don't help. All it does is help asset prices go up, and then when there's a sense that they can't do it anymore, well, investors are starting to get nervous. Bank of Japan, they came out and did a reverse twist, talking about it anyway. No, that's not an Olympic dive, though it's causing a pretty good dive, as you could see here. What happened is that they have too big of a percentage of the long bonds. So that what they're talking about doing is, well, opposite of what the U.S. did between QE2 and QE3. They did Operation Twist. Remember, what the U.S. was doing was buying long-end bonds and selling the short-term bonds. What they were trying to do was to get the yield curve in and make the short-term, make the longer-term cheaper, so that, well, it would then stimulate borrowing, stimulate people buying houses and stuff like that. Well, the Bank of Japan went way too far with this. They've bought way too many corporate bonds. They've bought way too many government bonds. They own 5 to 10% of a lot of the major companies in Japan. They are a democratic society, right? Well, they have done all of this to try to stimulate their economy. What they've succeeded in doing is making so that there is not a lot of bonds out there, and that they have just gone way too far with a program that doesn't work. So they said they're going to do this reverse twist to try to steepen the yield curve a little bit. That means they're going to be buying more of the near in, because they can't really find any longer term things to buy, or they don't want to increase it to where they're overwhelming the economy or overwhelming those markets. And at the same time, they said, well, if it looks like they're they're tightening. They don't want it to look that way, so they might knock short-term interest rates down another 20 basis points further in the negative. So I hope I'm explaining this all clearly. And it just simply says they've gone way too far. The ECB's gone way too far. The Bank of Japan's gone way too far. Our Fed is now coming out and telling people that they are going to start raising rates, right? No matter what the conditions of the market are, the data that's been coming out is weak, but they know that these world rates, the world rates are ticking up. German bonds getting up past the 0 point for the first time in months. This is really a huge change, and it just says that they've gone way, way too far. You know what we're going to call it? Game over. End of it. End of the road for this stupid actions we've seen in this giant experiment by the central banks. And that is starting to show up in these markets. Investors are very, very anxious, and they are just selling bonds like crazy. And this is just day one of a stock market decline. And you may get some bounce in stocks, but I say hands out and two hands and sell them like crazy, because I don't think that there's going to be any rallies that hold in here for the stock market for a while. If you think about it, reports have just come out that money is moving out of managed fund areas and into ETFs in a giant way. Well, they've been doing that for a long time, but now it's accelerating. Money actually going into bond funds also, and I think those people aren't happy about it. But now you've got this massive interconnectedness of all of these ETFs, all of these stock indexes, all of these people massively in the stock market, because, well, there's nowhere else to put their money, right? Because interest rates have been zero. But now that big sucking sound, if interest rates start to go up and the money starts to flow the other way, the stock market could be in huge, huge trouble. So big movements that we see here going on right now. Dollar, well, it had a big down day on Tuesday, and that helped gold and silver to have big days. Silver had a giant up day, up about 70 cents. But then most of those gains lost in here as liquidation is going on. Remember, stock market falling hard, deflationary attitude. Gold and silver do not do well under those environments. So they started to look okay, but now a safety bid has come into the dollar on Friday. So we're starting to see gold and silver moving down again. In that bulge, we took advantage of that. We put out a couple of setups on gold stocks on the short side, gold and silver stocks, and I know our viewers are doing really well on those right now. The oil market, well, it had a big 4-day upward move as the discussion of this freeze got heated up. Iran seemingly getting more on board with it. But now they're talking about ceilings versus a freeze, and that's going to mean that Iran's going to want to put a higher ceiling in there. They want to get their production rates higher, and this whole thing is likely to fall apart or be meaningless. So oil moving sharply to the downside here on Friday. And other things, of course, in the news moving markets, the polls are coming out, and Trump is evening it up, and that has to have investors also very scared. Well, you got to be scared about Hillary Clinton or Donald Trump, and maybe that's as we're getting closer to the election, some 60, 61 days away, that people are really, really nervous about that. So that's plenty reason to add it on to what's going on with these central bank disaster that we've got headed our way. A good reason to believe that investors are going to tighten up their belts, and you could see the aggressive selling that's going on right now. One more comment about Apple, because Apple started to lead the way on the downside. They came out and brought out their iPhone 7. Got a great cam in there. It's affecting GoPro. I'll mention that later on. And also their iPhone 7 now waterproof. But overall, they're really, really disappointed. And yes, they canceled the audio jack. There's no audio jack in that iPhone 7. I still have my iPhone 5. I'm hanging on to that. I'm not upgrading it. And I'm angry about that. And plainly, that iPhone 7, it's just one jack off. What? All right, so let's take a look at what happened this week as we look at our 60-minute chart of the S&P 500, the ES. And here is that chart, and you're going to see some giant movement here late in the week. You haven't seen a chart that looked like this in a long, long time. Well, on Monday, of course, not much happened because it was Labor Day and the markets were closed. And then on Tuesday, we saw some action going on. Morgan Stanley, they came out with a report, and they said the multiples say that the S&P 500 is going to go to 2,300. Well, 2,300 on the way to a 40-point decline, at least here today so far. And what happened was the ISM service index came out. It was much weaker, the weakest since 2010, and that got a break in the market. But then people started to say, well, market weakening, central banks will be easy, and that brought buying in again, this same trap that everybody seems to be getting in all the time. The dollar had a big crack. Gold and silver giant jumps, as we mentioned on that day, and we started to sniff out a peak in the NASDAQ, and we actually put a sell out in there, and we were wrong for a couple of days as Apple got a little bit of rally into that news. On Wednesday, it was really mixed. Transports had a huge upside day in there as Delta came out with good metrics, and Apache came out with a 3 billion barrel oil discovery. We're going to talk about both of those as we get into our best and worst of the week. So you can see we got a little bit of a rally there late in the day. Thursday came out that news, ECB, Bank of Japan, and everything changes, and the bonds have a huge plunge. And look in here, you get this kind of triangular shape right in there. The news really didn't really take hold until Friday, and Friday really saw it happen. Equity markets lower around the world. We have our biggest drop in a couple of months, and it's plain and simple. I'll be repetitive. The Bank of Japan, ECB, all out of bullets. Fed ready to start raising rates, and Rosenberg comes out and he says gradual tightening in here, but rates are ready to go up. Sentiment changes huge. Oil has a big break to the downside. Bonds big break. Gold moving down, and the dollar getting a bid in a flight to safety in what we think is really a tough pattern for the dollar also. Take a look here at the calendar for the coming week. And not a lot going on in the early part of the week. You'll note that there are no earnings of our 320 stocks that we look at because there's nothing in there at all. And if there's anything that could move markets, we have a lot of economic reports coming out here on Thursday. Philly Fed comes out, Empire State, and then on Friday we get consumer prices and consumer sentiment. So, but the markets are going to be moving all on their own, and it's all about this interest rates and all about the fact that they see a changing world out there, and a central bank that has been just injecting the drug into these markets for so long just simply come out and saying and telling us the story that they don't have a lot more, and the markets are getting ahead of what could be some serious negative discussion out there about interest rates, about changes in policy, and we're, I think, about to see a big correction in the stock market. Talking about big corrections, I want you to make sure that you watch the special that we have in today's show. We're sharing a member video that we did about election year, so I want you to make sure that you take a look at that. So that is the opening segment for the week. We're going to be right back with the best and the worst for the week and lots more. So stay with us. Best of the week, had a couple stocks that had some really big gains. By far, the biggest gainer was Navistar. Navistar jumping up big as Volkswagen takes a 16% stake in the stock. Says that they're going to put together some of their businesses, and that's $256 million for 16%. That actually seems pretty cheap, doesn't it, for a company like Navistar? Anyway, take a look here at this weekly chart that you can see here. We actually had it in what was late in a rising zone. We didn't really figure that anything like this could happen, but just a massive jump. Look what happened on this week. At one point on this big gain here on Tuesday, we saw it up like almost 60% on the day. It was just absolutely enormous, and still a very big gainer now at about 40%. And Cummins CMI was dropped about 6% on the week because this would make Navistar and the combination with Volkswagen a much bigger competitor. So Cummins took a hit on this news, but a big gain in there. We actually see the stock as a buy around $18 or a little bit less. So do have to say that wait for a little more pullback, but I think it's buyable on this. Chesapeake CHK and next stock up about 19% on the week. Wunderlich has upgraded this stock, says that their target's around 10. I say sold at 8. The big resistance here, right here at 8. Take a look. Let me get this pointer up here properly, and you could see right in here that resistance coming in around 8. I don't think it's going to get past $8. There's just not a lot left to this company after selling off all the assets. Talk about assets. Apache gets a big jump in its assets. They have a 3 billion barrel oil find in Texas. Stock up 16% on the week. You can see the beautiful cyclical action in here. These down over here, the cycle brackets showing you the important lows or troughs in the cycles. And this one came a bit late, but then in this rising zone, we think it's going to go much higher. So I think that you get a nice dip in here. I think it would be a good opportunity to buy. You can see in here as momentum now turns positive on the daily chart on the slim ribbon. You want to get the slim ribbons on your charts? Well, if you're a TOS subscriber, you can just go to my site into resources, and we have the script there for you for the slim ribbon. This is a momentum indicator that I think is excellent. So 3 billion barrel discovery breaks out over the 89-day moving average and looking like a good chart. So we say buy pullbacks in that one. 3 billion barrels of oil, no matter how you count it, is a big find. Western Digital, the next one we're going to look at. Well, excuse me. And here is this chart in here. Now note that we have in there, we've been very bullish on this one, and Seagate, STX, and they have been just powering to the upside, and we've been long these. And you can see this inverted head and shoulders forming in here. Note the cycle bottom time right in here and the next rally. If it gets above that level, above that, let's say 56.5, 57, it will be an inverted head and shoulders breakout and point to this area up in the mid 70s. That might be after a stock market correction, but we think it is still some time away. We could get a big move over the next couple of months. So that is a great looking pattern in there. When you look at the pattern in here in Seagate STX, you're going to see a very similar pattern also. Come on up here. And then you'll see STX, this one a super powerhouse. During this declining period, it could only give you this little triangular sideways correction and then moves big up to the upside again. So STX, another one in this category of storage makers, it's looking absolutely great. The next one, Tesoro, TSO, actually liking this stock and the group. It's been in this rising phase. Valaro was the one we were long, still liking Valaro, and Phillips, PSX, are still bullish, and you could see it moving up here, getting above, but not holding above that 34-week moving average. That is significant. So if you wanted to buy this stock, you'd probably have to wait for a bit of a pullback and then hope that you get a move above that 34-week moving average. You think it's significant? Support, 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 a breakdown under it and then tries to get back to it and can't and turns down. This over here, a key area that you can see, 34-week moving average. That's my replacement for a 200-day moving average. I think it is a lot better. So that's a look at Tesoro. Other stocks on the downside this week. Airlines definitely on the strong side this week. Airlines big moves. Delta really started it. It was a 6% gain on the week for Delta. They showed stronger margins, stronger traffic, and that led the group on the upside. Copa also had some good news. That was up 7%. American Airlines up 7%. United Airlines up 5%. And in this world of low-priced oil, if we don't get into some kind of an economic collapse around the world, and things are looking ugly at the moment, right, then I think the airlines are going to be a buy on pullbacks. Just be a little bit patient on those. One more stock worth mentioning, Chipotle, up 4%. This is up 4% on Ackman. That's Pershing Square taking a 9% stake in the stock. I'm going to say the worst is over for this one. It's had a monstrous hit on the downside. They are trying to do things to regain their customer base, get more confidence in there after all the people getting sick. I think Ackman's onto something here. We'd like to buy the stock in that, we'll call it 415 to 425 area on a pullback in here, and then I think you'll get paid on the upside after that. That is our best of the week, and we'll be right back with the worst. For the worst of the week, even though we have a market that's plunging on Friday, there wasn't that many stocks that had really big declines because, well, overall for the week, as I'm doing this recording, the market's, down only about 1.5% for the week. Probably more to come. We'll talk about that. And the biggest loser for the week, down about 12%, U.S. Steel. This stock analysts have really started to hate. We've heard some analysts talking about much lower prices in here. Really what affects the steel stocks the most is the price of iron ore or the base metals. And you can see in here as we look at the U.S. Steel weekly chart, it's been in this yellow zone, and we have talked about it in this declining zone. There's really no news to talk about. It's just that this line over here, that blue broken line, that's the DBB, and that is the base metals, and that's also in a corrective mode. Now note, coming right down here to our support level, and another support level down around, we'll call it 14 and a quarter. It's now trading at 16.95. We expect that, this 34-week moving average around 16, and this support level we're at in the 16s, we kind of think that that's the area that's going to hold the stock right now. It's had a pretty big drop, and with DBB weakening, which is the aluminum, copper, and zinc, those are the major components to that. Then we think there's still a little more time in here, but probably price-wise, the worst is over for here in U.S. Steel. Next one we're going to look at is GoPro, GPRO. This is an interesting story in here because GoPro is taking a hit. Now you can see the stock was a $98 stock. It fell all the way to $8, so it was a big decline. Let's just take a closer look right in here. And what's happened in here is that the stock took a hit based on iPhone 7 coming out, because the iPhone 7 camera is a huge upgrade, as we said. This stock to us is completing a base. You can see the cyclic action in here. Now note the rally and the early failure and the decline right to this time frame. The rally and the early failure and the decline right to the time frame. The rally, but it goes really long in the cycle, and it only leaves a little time to decline. So to us, this looks like the right time frame for a bottom to be forming. We see the supports between 1270 and 13. So even though it was the worst of the week in that category, down 10%, we actually think that this fear of the iPhone competition is unwarranted. I don't really want to be tying an iPhone to my head while parachuting down and taking a video of it. No, I don't parachute anywhere. But I do think that this is a bottom coming in right now, and that iPhone competition is not real. So I think we're getting set up for a buy in here. On the downside, also of some significance, Sears down 9%. This stock trades down to $12.30. When it was in the 20s, we said it was going down to the teens, and now that we look at it now, we still think it's going sub 10. How's that? So that one down 9% on the week. Royal Caribbean, RCL, gets an analyst downgrade. These stocks, Carnival Cruise also, I mean, they're not absolutely looking great. As a matter of fact, they have been in a declining mode, but what I want to do is put up this chart in here of RCL, and you're going to see a stock that probably is at an important support. Man, talk about important supports. I'm going to be able to draw a line across in here in RCL, and you can see what a key level this is. Look at right across over here, right? You can see what stock just keeps leaving these hammers right over here at this level. But now see this big red bar this week, it's kind of going through it. Cyclically, it has 2 or 3 weeks, so I think there's a throwaway coming in here. I don't see the bottom yet in here, and this analyst downgrade is weighing on it, and we're going to look for a capitulation in here over these next few weeks with lower prices. Pretty tough to say where that buy is. You could see it got support way down here at 52 way back there a couple of years ago. It's now trading at 65.5. I don't think that low, but we're just going to have to let it talk to us and see. The next one we're going to look at is Avago, AVGO. This is Broadcom. Had that name change. Look at this stair-step upward pattern that it's been in, and note the intermediate support that's coming up in here. 8% down on the week. Interesting. Analyst bullish comments on here, and we've been bullish on this stock except for this corrective period. So if you look in here, you can see big patterns, right? That's this one right in here, and then this one right in here, and then this one right in here. You see that? Made up of 2 pieces. You see these right here, 2 pieces in each one of those big ones, and look at the beautiful cyclicality as these things form. I'm just filling in the cycle patterns for you here to see, and in this corrective mode right in here that has, we'll call it 2 or 3 weeks to go. Pretty much what we're thinking about the stock market, in declining mode for that period of time. So intermediate support, we're going to look for a little further decline in here, possibly as low as that area of 155, but that would be a buy area. Note the 34-week coming up to that support zone. 2-3 more weeks and you think you buy it. So keep your eye on that one. Decker's down 7%, DECK, and this chart in here, that's another one that has just a couple of weeks potential on the downside left. Here again, you can see the cyclicality in here. Watch it. Small rally, big decline, small rally, big decline. Bigger rally makes a base, doesn't make a new low, says we're going to go to new highs, and there you have it. And now in the corrective mode that has maybe 1 or 2 weeks to go, 34-week moving average coming in, put this one on your radar as one to be looking as a long side entry in once this stock market plunge is over with. So that's another one that's down 7% on the week, but probably setting up as a buy. Whole Foods, that one gets hit. This one's been in a bad looking pattern in here, and we have had it in a declining mode, which we believed would end sometime around October. These 2 blue spikes are there for our subscribers to see that this is the window of time that we expect this declining mode to end, and so that's a couple of months out there really, and we don't think that we're going to get any big improvement in here. Stock falls 6%. That's because Sprouts, they lowered their outlook and fell 16%, and of course that's a competing company, so that one gets a pretty big decline, leads Whole Foods to the downside, and we're not a buyer in there for, we'll say, at least 6 weeks. The last stock in the worst of the week is Twitter. Twitter moves down about 4% on the week. They came out and said they have no bids on the table. Everybody's thinking about this stock getting bought out. we see this another couple of weeks potential on the downside. I'd love to buy it, absolutely love to buy it between, let's say, 1670 and about 1730 down there. That's where I think the support is, and where I think we're going to get a nice buying opportunity. And then I think the stock goes higher again after that. So a lot of stocks you can see setting up in declining phases that have 2-3 weeks to go. And when we talk about our short-term view, we're going to talk about that time frame as this period for this market decline, and that I think is going to set up some buys after that. So as you can see, Twitter looks that way, and we want to buy that one in this dip. All right, that is it for the worst of the week. And I'm going to be right back. Have some good special piece coming up right now. And after that, later on, will be our short-term view that all of you like to see. But this special piece that you're going to see is a member video. And this member video is one we did on the big picture of the stock market. And that was one that we did on a very, very interesting comparison of election years. Of course, this is one. And something happened in 17 election years, going back well into the 1960s, right? Or earlier than that. I can't remember the date, but it goes way back. And you're going to see something pretty amazing. And this is one of those years, and something is happening now. So you're going to want to catch this piece, a special member video that we're bringing to you. Big picture analysis, stock market, election year comparisons. All right, we all know it's an election year, and that election years tend to be up years. Well, why is that? Well, generally it's that the FOMC is accommodative during those years. And they don't want to see the markets come apart during that time, so they tend to keep interest rates low. Of course, this is a much different time because interest rates have been near that zero mark, and around the world, 23 countries have negative interest rates all the way for the last 8 years. So this is a very, very different time, and actually a very different election. I wanted to look and see how different 2016 might be and what the history was about election years in the second half, even though there is good consistency with the majority of election years being to the plus side. So what I did is I went back and I looked at the last 17 elections, essentially post-war elections since 1948, and wanted to make that comparison. So I think I've got something here very interesting. 17 election years that I looked at, and there's going to be some consistency there, and I think the results that you're going to see are a surprise. They actually were a surprise to me, and we're going to take a look at them. So how did I do this? Well, I pulled up profit charts and went back all the way to 1948 and actually looked for second half corrections. In other words, even though it was an up year, we're in a market right now that is up for the year and is apparently very complacent. Hardly any downticks at all, and certainly implied volatility is very low, and the market, right at this moment in maybe summer doldrums, not a lot going on, so we're kind of all being, lulled to sleep. That usually means that there's some kind of a big move coming, and, it could be to the upside or it could be to the downside. But what historically happens in election years? So let's go back. We're going to look at this chart. And what I want to pay some notice to is that, is there a correction in the second half of the year, in the election year? And, how long do those corrections last? Not so much thinking about, well, is it a decline that then the market turns around and moves up again? More right now thinking about, is it a decline that, is consequential? Does it, what's a big enough decline to matter? A lot of traders would think right now a 3% drop would be pretty good, which would be some 60, 65 points in the S&P 500. I know a lot of traders that would love to see that. And then some investors, well, they might think 10% would be a lot to stomach. And could we even expect 10% to come? I mean, is that a reasonable decline to expect? So we're going to look at some things here that are very interesting. Here is a chart that we're going to go back and look quickly at 17 election years. This is the chart of the Dow Jones Industrial Average, and I have noted in here each election. Now I didn't write down the amount of correction that happened. I more wanted you to see that there was a correction in the election year and take a peek at, well, how long it lasts. So here you could see 1948. That is November of 1948 when Truman was elected. So what we're looking for is this last half correct period in here. And did a correction actually come in the election year? This actually was an election year that was, basically unchanged, maybe up a little bit for the year. That's where it closed. That's where it opened, but it was pretty choppy, right? So you can see that in this election year right over here, when Truman was elected, it actually had a decline that was some 10.5%. In today's points, that would be something like 230, 240 points in the S&P 500. So we're going to go from one election year to the next. This is 1948. You could see that right there. So we're going to go to 1952, and you can see in here, when Eisenhower was elected in November over here, you can see that actually in August, September, and part of October, there was a correction in there. It lasted about 9 or 10 weeks, but then it went up to new highs. I'm going to show you afterwards what what the corrections were like in each of these years. But here you can see an up year that had a second half correction that was pretty sizable, and I'll show that to you in percentages when we get to a table I constructed. So that was 1952 Eisenhower. In 1956, when Eisenhower was reelected, you can see in here an up year, right? But note in here in this August-September period, there was a month decline that was very sizable. You can see in there that it actually came popping back, but you had a pretty good size correction in there. If I come back, that was 1952, right? 1956, actually, when Eisenhower was reelected, there was a very sizable decline in there before the election. So you can see that one came in August, September, October, and into the election time right there of a very significant decline right there. That was kind of late in a bull market. So that was 1956. We're going to jump up to 1960. And we'll bring that right over here, and you can see in here JFK elected right up over here, 1960, and you can see in here just this secondary correction right over here was in September, October, right in here. It lasted about 9 weeks and was actually a very sizable correction. So that was 1960. Go to 1964 right out over here, and you can see LBJ elected. Not much correction in there, right? Actually, there was almost nothing in here, a tiny one right there, and then a post-election decline right over there. Not very big, but I'm going to show you in there that that was just a tiny one right there. Didn't last very long, just 2-3 weeks right there. So that's when LBJ was elected in 64. We jump out to 68, which was a very, very wild election period, and you can see in here that it had a pretty sizable a decline or correction early in the year right there, and then didn't really have a whole lot of a correction as we got close to the election, just 2 weeks right over there, and that was about a 5% drop in 2 weeks. In today's terms, that would be over 100 points in the S&Ps, but not much there when you look at that in 1968. 1972 we're going to look at right here, and that's when Nixon was reelected, and you can see right, did I jump past 1968, we got that one right. 1972, okay. As we had the Nixon re-election, and you can see right over here that right in the September-October period, a 10-week decline. That was actually pretty sizable coming into the election, but then a big rally then after the election right there. So closed the year very, very strong. That's 1972. 1976 is when we had the election, and that was when Carter was elected. I don't know why I think I've got it too close in here. You can't see Carter elected, but we had a decline in here in October into November of about 9 or 10 weeks that was actually quite significant. So every single election year but one that we've looked at up to this point has had a pretty sizable correction in it. And now we're going to jump up to 1980 right here when President Reagan was elected. And you could see right in here that there was a sizable correction right in here in October into November, and that was after the election right there, and that was pretty sizable. There was a modest correction comparatively right there, but that was still enough to be equivalent to some 130 or 140 points in the S&Ps in today's S&P 500. So that was 1980. We're going to jump up to 1984 when Reagan was reelected. And there was just simply a modest decline right in there, which would be surprisingly large in today's S&P numbers. I'll show you that percentage in a second. That was 84, right? Now we jump up to 1988 when Bush Sr. was elected. And you can see in here that there was a correction right in here, right into the election time that lasted about 5 weeks, just into October and beginning of November, right over there. That's 1988. 1992, when Clinton was elected, you can see in here in August, September, October, there was a sizable correction in the market right there. Then it had a modest recovery right after that. So that had a pretty good correction into the election. Also, could jump up to 1996, Clinton's re-election. Almost no correction right there. Just 2 weeks on the downside in there, and that was about, believe it or not, 5%. I'll show you that in a second. 5%, and that came right around the election time. Just after the election, it dropped about 5%. And that was when Clinton was elected in 1996. In the year 2000, when Bush II was elected, Bush the Younger, you had a very sizable decline right over here in the market before the election. Market trying to rally right there, right? Similar to what we have now, testing up near the all-time highs, and then rolls over for a pretty big break there. So that's in the year 2000. 2004, I know this is a little tedious, but I wanted you to see all of these corrections that came in these election years. Actually, this one was in June, and then this one right over here was in September, October, about 7 weeks. That was fairly sizable right there, right into election time. And then you could see it closed strong on the year. So 2004. 2008, of course, that was when the big collapse was going on. And this was a massive decline right over here into President Obama's election. So that was part of the financial collapse right there. So that's 2008. And then 2012, President Obama's re-election, and you could see in here right into the election a pretty sizable decline right there. So those were fairly sizable declines. And then where are we right now? Well, the only decline we've had this year is into the Brexit into June, and then we have been advancing for the rest of the year. So here we are in the second half of the year without having any kind of real correction so far, and here we are in the election year. So the question is, how big were those declines? Most of them lasted something like 8 to 12 weeks. There were a few of them that were only a few weeks long, one of them only 2 weeks long. And every single one of those 17 election years had some kind of a drop. Believe it or not, in the second half of the year coming into election, all 17 election years had drops of 5.1% or greater coming into the election. We've had none of that so far this year. In fact, let me show you a table that will help you see what this looks like right here. And we're going to look at each one of those years again quickly, and you'll be able to see the month that the correction started, who was in the election, the month that it started, and how long the correction actually lasted in each of the last 17 election years. Here is that table right over here. So starting with the one we started at, Truman, 1948, a correction which began in October, as I showed you, was 10.5%, and that was, of course, into election time and through the election. You could see 52. Eisenhower, the correction begins in August, 7.1%. Eisenhower 2, August begins 12.2%. John Kennedy elected, and that was in August. A correction began 12.4%. LBJ elected, and that was 1964 in October coming into the election, a modest correction of just a few weeks of 5.1%. Richard Nixon elected, 1968, a very, very hot year. George Wallace also in that election. Nixon wins. Correction starts in September of 11.6%. Richard Nixon's second election, of course, he didn't last because he resigned after that, 1973. But look at that. As in September, a correction began, 14.7%. 76, Carter wins. In September, the correction began with 10.6%. In 1980, Ronald Reagan, 11.6% correction. It came in November. That was post-election. Ronald Reagan 2. In October, the correction started, a modest 5.8%. In 1988, George Bush, October, the correction began, 6.5%. When Bill Clinton was elected for the first time, a correction began in September of 8.8%. Clinton election 2 in December showed you only that 2-week drop, but it was 7%. So that was one that didn't really fall around the election time. That's the only one, but it still had a 7% correction in December. George Bush Jr. Elected in 2000. In August, a correction began of 15%. George Bush the second election in 2004, a modest 5.1% correction. 2008, the big bear market, Barack Obama, 37.5% crash. And Barack Obama's second election beginning in October, before the election, an 8.6% decline. So you can see, as I shared that with you, that as we looked at each of the charts, we saw the duration lasted generally in the order of, let's say, 7, 8, 9, 10 weeks. There were a couple that were shorter ones. Most of them began in September, October, before the election. The real minor ones were 5%. And let's forget about the financial crash, 37% when Barack Obama was elected. There were quite a number of them that were in the 11 to 14, 15% category in declines. Very fast declines moving into the election. Now, you could say, this is a year that's different. Is this a year that's different because the Fed is holding at 0% interest rates, so does that mean there won't be some kind of a decline? Is this a year because Hillary Clinton leads in the polls, and if Hillary Clinton leads in the polls, it means that Barack Obama 3 is essentially in the cards, pretty much status quo? Is this possible that the polls change and everybody gets scared of Donald Trump might be elected? There's a lot of other things that could cause a correction. And note that I have been talking about the fact that I thought that the bond market, inverse correlation to a stock market decline, would soon have a rally, and that this very well could be in alignment with that. What I've showed you is that every single one of the election years for the last 17 years has had at least a 5% decline in the last half of the year coming to the election, all actually starting August or September or October. So here we are at the end of August, so it's essentially September, October is what makes the most sense. And declines were, reasonably, 5, 6, 7%, and not excessive at 11 to 14%. That is probably shocking, right? Because nobody really expects much of a correction, especially here in election year. But I just showed you that every single one of those election years had some kind of a measurable decline. Granted, a couple of them were only 2 or 3 or 4 weeks long, but nothing less than 5.1%. So what does that mean in today's terms if the stock market were to have some kind of a significant break? Well, here's the S&P weekly chart in here. And what I essentially put in here was the corrective levels in here, and also put in what the percentages would be. So how does that work? Well, right now as I do this, the S&P 500 has made a high of the 2193.81, an interday or interweek high right there. I've talked about resistance, in this area, and also at around 2212. So, if it was a modest year, if we're still following the trend of some kind of a decline in, September, October, beginning in September, October, as in the last 17 election years, a modest 5% break right over there, which would be above the intermediate 38.2%, would be down over here, down to 2081. That would only be a 112-point break in the S&P 500. Truthfully, that's my highest objective for what I think is going to be the 18th in a row as far as some kind of a decline in an election year. If it were all 7.5%, that would take you down to 2031, which would be a 162-point decline. And if it were a 10% break, it would be down to 1974. Which would be about 220 points on the downside in the S&P 500. Back over here, when we were looking for corrections, we had these in here. We thought it would be a 10 to 15% drop, and you could see it pretty much nailed that 15% number in 18 weeks. That was the end of a big declining cycle, and we may get into one of those before you know it. So it would be reasonable to get some kind of a break in here of at least 110 points in the S&P 500 sometime in the next couple of months, based on everything we're looking in here. I'm not really talking about cycle analysis. I'm not really talking about anything in the background other than the fact that maybe markets do get a little bit nervous when you get into election time. And we've seen that the majority of those years have had these pretty sizable corrections. 5%, some people might say, well, big deal, they could sit through it. Of course you could. If you're an investor, that wouldn't be a big deal. And we've seen a lot of years where you've had corrections of this, 5 to 7%. Maybe 4 or 5 of them out of the last 17, and then the market roared to new highs in there. So maybe that's all it is a bit of a dip, but 100 to 150 points on the downside in the S&P 500 would not be a surprise, and for traders it would be a big deal, especially for volatilities. And as you can see, something like 150 to 200 points would be pretty normal. Based on everything we're looking at. You look at some of the elections that you would say maybe years that were a little crazy stuff going on. 1968 was a big one of those. That was Nixon and, of course, George Wallace, and that one, he beat Humphrey. That was an 11.6% decline in like 2.5 months. You look at the first year that Reagan was elected, I'm sorry, the second year that Reagan, no, that was the first, 1980. And that one, Carter had a pretty good sized lead, and then all of a sudden, Reagan came storming back, and all of a sudden, the market didn't like that, really. And Reagan ultimately got elected, but the market declined 11.6%. This is one of those years when things are crazy. And it wouldn't surprise me to see that 10% drop. I'm not going to call for it. I'm just going to look at what these norms are. And it looks like 5 to 7%, pretty normal. And maybe we could see something bigger. That is the big picture analysis for today. I think I made it pretty clear that, it could be a normal correction, normal decline. And 100 or 150 points in the S&P is going to feel like a pretty sizable drop, and it's going to shake some people. Let me know what you think about this analysis, and I'll see you in the next segment. All right, before we get into the short-term view, I do hope you enjoyed that special we shared with you. That's a member video, the big picture of the stock market for election years. We do 8 different categories of member videos. You can go to our website and you can see how that breaks down. That's for level 2 memberships, and we do 4 videos every week. They get put into that library, now over 250 videos in there, so unbelievable amount of things for you to learn about trading and investing right there in our library. Also want to reiterate, we've got a special now. Time is growing short on taking advantage of this, where you get all of our videos and you get our rankings and setups. That's special 3 different time frames that we rank stocks and futures and ETFs on for long-term, intermediate, and short-term traders, and we put out setups when we think it's right based on the analysis, and we put out usually about 1 to 3 of those a day. So that's our level 3 membership. You can actually look at that for half price for 1 month. All you have to do is send me an email, slim@askSlim.com, and I'll send you a special link, and you'll be able to get that half price 1 month of all that unbelievable information, all of it available to you, and our rankings and trade setups. All right, short-term view of the coming week. We take an accountability of how we did in the last week always. We went from being on fire to being just relatively good, and we'll call this week at about 70%. Really kind of missed the gold market because it widened the range that we expected it to be in, and the more volatility that we expected in the dollar brought a little different trading than we expected in the euro. As far as light crude goes, the bond market and the stock market, they did pretty much what we expected, and we're going to go through that. We'll show you what we looked at for the previous week and what we expect in this coming week. We're going to start, as we always do, with light crude. So here is that light crude daily chart. We're only looking at daily charts because we're looking at the short-term perspectives in here. This one, we happen to have our intermediate cycle put in here. You can see that this is where the declining phase was, and that is where the rally phase was. So that is what we work inside of here when we do that. So in other words, inside of this declining zone was this big pattern right in here, and made up of several smaller patterns that are right in here. And then when you look at this rising intermediate phase right in here, you can see the big phase that's right in here made up of several smaller ones right in here, and this one we are in right now. So last week, what we said that we expected, let's get a little closer look right here, was that it would be a week that was down early and then tried to rally. So we actually have it drawn essentially like this on our notes. We thought it would test resistance between 45.50 and 46.70. It actually got up a little bit more than that, went to the next resistance at the 89-day moving average. And then you can see the engulfing pattern today. So it pretty much did what we expected. It went a little bit higher. Now, that's because we believed that we were in this intermediate rising phase. Now, where we are right now is coming into this declining phase right here. So what we expect for the next week is that it would probably be a down week. You see the minor support right over here? Our support levels are right around 44.60 to 44.90 right there. So 44.60 on this short-term support, 44.90 right at the bottom of that support. We kind of think it's going to be really a modest down week and get down and test that level. The background news really is not great, where they're now believing they can't get any kind of a production freeze, the producing nations, but more about getting ceilings. So I think that's going to keep pressure on this market. We're just going to call it a somewhat of a down week, not anything huge, but still under the pressure of this the phase right over here. Now note, we think this upward trend remains, and then after that you get some more rally after that. So just this next week we think is going to be on the sloppy side in there. Next one we're going to look at is gold /GC. We have our 2-year charts here, so we're going to move it in so that you can see we have a lot of analysis in here. Now what we expected for the last week was that it would get down to close to 1300 and be in a narrow range, 1300 to 1335. Now it got down to 1306 right there on Monday morning, and that's actually right here. And then it got into this big rally because the dollar had such a big down day on Tuesday. And now the dollar is getting bought today in a flight to safety bid, so we're getting some selling coming in there. So what we expect is that there's a pattern in here that has a high probability of an advance. That's this rising 3 methods. It's made up of a big up body and 3 down bodies that are inside of the up body. The odds are high that in the next day or two you're going to get another attempted rally after that. So that's what we expect. We expect 1325 to be a support area, and somewhere between 1358 and 1373 to be the resistance area. And then it kind of roll over again for some more correction in there. You can see how we have it drawn. So on our notes we have it simply drawn as an up-down week like this, and we're going to really call it a small week, maybe a small up week, but not a lot of change in there based on this on the 2 patterns that we're looking at. One being likely to get an uptick, and one being the resistance level, and the markets being so weak that are likely to keep pressure on it. So that kind of tells us more that it's going to be in this range, 1325, 1358 to 1373 on the upside. So that is a look at gold, which we would say, because we thought it would 1335 was the top of the range, that we get no credit for that for the last week at all. Up $17 for the week, $16 I think actually, so not a very big change on the week, but above the range that we expected. /6E, that is the euro currency. That is also affected by the bigger moves in the dollar. So the safety bid that's coming into the dollar is getting it to fall today. That's the down day that you see right over here. We expected last week a 111.30 to 112.30 range. So we thought that the range would be right in here, 111.30 right there, 112.30 at the bottom of the resistance zone right here. So you can see that it basically got, a little bit lower than that, and then tried to get up through the resistance and couldn't really get there. So we think that this flight to safety bid in the dollar will remain for a short period of time in here, and that is going to mean probably getting a small week on the downside in the euro currency. Now here's the patterns we're looking at. You can see the big pattern, and the big pattern. See how that's shaping up? And you notice that there's an upward slant going on in here. So that's the intermediate reads that we're looking at. You'll also notice that each of these is made up of 2 smaller patterns that you can see right in here. They're not perfectly formed, And right now, this rising period is likely ending, and we're getting into this corrective period. So we see this as a minor down week in here. We think we'll test support right around this 111.30 to 111.50 area over the next week. Nothing big on the downside. I think the action is going to be much more in stocks and bonds than it's going to be in the currency markets. So that's a look at the euro currency, and we're just going to say it got out of our range by a little bit, so we're only going to take about half credit for that one. The bond market, now this is interesting because we thought that the bond market would have another down week. We talked about that. Now, it made us look wrong, and when we did our Wednesday future speak, we were wondering whether or not this elongated selling was some capitulation. And really, the capitulation, we think, is right there. So we thought it would be a down week. It is a down week in there, even though it tried to get up right over there. This worldwide jump in interest rates or decline in the bond market is really putting pressure in here on the bond market. The ZBs have been just getting hammered in there. So what we thought would be, a small down week, we get it, and now it looks like there's still a little more time in here. So that means there's still likely to be some downside pressure in the bond market. What we see in here is about another 3 to 5 days of downside risk based on this pattern. We expect to see a test of these different supports potentially in here. One of them is right over here. The 618 is 129.27 right over there, and there's another intermediate 78.6%. Right about the same place, so that's kind of a support area right there, and then way down over here at 129.10 is around that next one. So that's kind of the next 3 to 5 days. We expect that there's going to be some more tests of these supports and even breaking through this nearest one right over here. The ZBs, that low, that test of support is around 164.30. For those of you looking at the ZBs, that's kind of the area we think of as a key area to test and that we want really to see it hold for the intermediate pattern to be as positive going forward as we have expected. But the bottom not yet in place, and we're going to say 3 to 5 days still before we get what looks like the period of upturn. Now, if the stock market gets into a collapse mode, and it sure is in free fall mode right now, we'll talk more about that, that's going to prevent probably a lot of disaster here in the bond market, because you'll start to get a flight to safety bid in there also. So that's a look at the bond market. Now let's talk about the stock market. It was interesting because, like I said, we had Morgan Stanley come out earlier in the week and talk about 2,300 as the near-term target in the S&P 500, which I say sold to that one. And we said for this last week that we were entering a high-risk period. And we thought, with risks increasing, we thought that if the market, the S&P 500, got below 2156, that it would accelerate to the downside. And we said that if it made a new high above 2194, then we were going to be wrong, and that 2212 was the next target. So we ended up being right, and the stock market really coming apart. I mean, when you get a 40-point down day in the S&P 500, you've got some real selling. And this is just day one of it. And so you don't expect to get, an anomaly like this where you get one day and then they move back up. This is not the Brexit, where people are afraid of what that Brexit means. This is people afraid of central banks losing control of a whole changed world out there, and massively loaded up in the ETF markets because that's the only place that they thought they could go. And as the domino effect hits these thousands of ETFs as people lose money on the downside, it just all builds on itself. And that's what we think we're in, kind of a free fall situation as we moved into this high risk period. We've broken down under a head and shoulders top formation in here also, and I'm going to show you why I have labeled this a high risk period, because we have this multiple cycles moving to the downside, and that is free fall mode. When you get big one like this moving down, and you get the intermediate one like this moving down, and then you get the shorter term ones right over here moving down and right over here. So this one over here has got a couple days left in it, basically. So kind of what we think in here is that the way the pattern shapes up is that it comes down, tries to rally, and then comes down again in a big way. So that would call for a couple days down, a couple days up, and then another acceleration to the downside. We're looking here at this head and shoulders measurement coming in exactly at that support at around 2117, 2118. That's our highest very short-term target for the S&P 500 right now. It could get down to the next support level around 2093. Now, you just saw what we talked about if you watched our special on the what we thought would be a minimum of a 5% decline before election. We think it could be a lot more than that. That's this level right over here that we put in there at the 5% correction. And that one is at around 2083 down over here. We think 2083 is going to get hit in this decline based on everything that we're seeing in here, all of these cycles that are pushing down. So that's my intermediate look. I'm going way beyond what I thought I would be doing. But the short-term look for the next week, we'll call it down and attempted rallies, and any attempted rally that continues to fail with a lot of downside risk for the stock market. Wow. Boy, we showed you a lot today. This has been a long show because we inserted that special for you to see. I hope you found value in there. Please do try us for a month for half price, and I'll send you that link. Write me at slim@askSlim.com. Our information, I think, is unbelievable because we have a huge breadth of understanding of the markets, and that's what we try to bring to you, really to raise your probability of success, is an opportunity to grow. We don't give trades. We simply share our analysis, say when there's setups, say how we got there, and then let you develop as a trader. Hope you loved everything in here, and I will see you next week. You have a great, safe weekend, and we're always wishing you great trading.